that is a recipe for growth. That's a recipe for success. That's a recipe for a growing economy. Those are all the things that a smart person would want to be doing in an economy. So I think that is incredibly positive for the U.S. We've missed out on about $670 billion that has not gone into projects in terms of investments. Other capitals left the country. So you put a socialist regime, a social welfare system across our country, and then you're not creating the wealth to pay for it.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next.
Jonathan, thank you so much for joining us today. How are things in the great city of Toronto?
Well, they're plodding along in Toronto, probably at a slower rate than I would like. We're trying to get more money back into the city and trying to get some economic growth here in Canada. So that's the challenge that we're facing in this country.
I always enjoy speaking with a fellow Canadian, and I do want to have a discussion with you on Canada and what's happening with that economy. But before we do so, I got to tackle the U.S. first. There's so much going on there, and we are in the beginnings of the Q3 earnings season. And so far, we've seen all the earnings out of the major U.S. banks. And for the most part, they hit the ball right out of the park, and they're all trading at or near all-time highs. Citi's up 40% on the year. JP Morgan is up 30% on the year. Goldman Sachs is up 30% on the year. And it looks like we've seen a big resurgence in M&A, IPOs, and advisory. But what's your take so far on the earnings we've seen out of the U.S. financials?
Well, the numbers have been, as you pointed out, exceptional, especially, as you say, in the investment banking and the different, a lot of transactions going on. I mean, underneath the hood, there's still the concerns, of course, for consumer debt and write-offs and the mortgages and mortgage debt and so forth. And that I think is acting as somewhat of a drag, even with the stocks going up quite a bit. But overall, I mean, the U.S. economy has been pretty robust, and the leaders at the different banks are speaking in fairly glowing terms in terms of opportunities going forward and not too many problems that they see in the horizon. I mean, Jamie Dimon was talking about the employment situation being a little weaker and things like that. So we'll have to keep our eyes on that. But overall, they've been spectacular numbers. As I say, the biggest issue is going to be, I think, loans and mortgages and the housing market being soft in the U.S. as it is up here in Canada.
Jamie Dimon is always sandbagging his numbers, but then when they come out, they're just amazing. And he's always talking down the economy. But every time we see numbers coming out of the U.S. economy, they're always better than expected. I want to ask you about valuations now. I recently read a report from a research firm called Macro Strategy Partnership, and they said the AI bubble is 17 times larger than the dot-com bubble, 4 times larger than what we saw with the subprime bubble. But what are your thoughts about valuations right now? And do you have any concerns about what we're seeing, especially in the AI sector?
Yeah, I mean, the overall valuations are absolutely at the high end, and there's no question about that. And that has been basically, because of AI, that's been the one that's been encouraging the market. And there's a handful of companies that do trade at incredibly high valuation. So that's been a concern of ours now going back a couple of years, which has made us more conservative in terms of our asset allocation. We've kept some cash around, as we've talked about in the past. We've done exceptionally well because we've had large positions in precious metals and some of the areas that have done very well. So that has not held us back in terms of performance relative to the overall markets. But no, the valuations are high, and I don't think they're sustainable at this level. And so we caution our investors to be very careful that AI will no doubt transform our society and the way we do things. But you can't just put an infinite price on these securities. They ultimately have to trade at valuations that will justify a return on invested capital. And so with the amount of capital that's going in, it's hard to see that they're going to be generating the kinds of rates of return that they are traditionally have generated in these companies. So in other words, you take Google or Amazon, and you take, NVIDIA, of course. I mean, these are amazing companies, and they are growing very quickly. but you have to again adjust for what is reasonable price. I mean, if you're going to overpay, you can get your head handed to it. We've seen this before. Prices can come back even on great and successful companies. So we're cautious, we're careful, we're warning people. S&P is pretty close to 30 times earnings. As you know, it's much healthier if it's 18 to 20 in this environment. So that's probably a 50% overvaluation. So again, we caution people. We value investors, so we kind of try to look below the hood and try to find areas that are more appropriately valued, and that's the business that we're in.
I recently attended a conference in Toronto where Howard Lutnick was speaking, and he was talking about the strength of the U.S. economy and how it's currently trading around 3% plus, and he wouldn't be surprised if it grew to 4% in 2026. What are your thoughts on that, and do you have any concerns about the U.S. economy?
Well, I mean, the U.S. economy, if you think about what's taking place down in the U.S., again, I'm up here in Canada looking down south of me. I mean, it's amazing the transition that's taking place. Now, that doesn't, again, we'll talk about some of the challenges in a second, but if you're in a country that's attracting the kind of capital that Donald Trump is attracting back into the country, and you're lowering taxes and you're lowering regulations and you're making it easier for companies to develop the resources in the country and so on, that is a recipe for growth. That's a recipe for success. That's a recipe for a growing economy. Those are all the things that a smart person would want to be doing in an economy. So I think that is incredibly positive for the U.S. The amount of money that they're talking about coming into the U.S. I mean, they're talking about 10, 15, 20, up to $20 trillion of capital over the next number of years. That is massive amount of money coming back into the country. I mean, you're talking about over 50 cents on every dollar of capital investments going back into the United States, which is phenomenal. So I think all of those bode well for the U.S. They're also cleaning up, their borders. I mean, I know some people talk about, illegals being lower cost, but if you're putting the money back into your own people, and even if wages are going up, but you're now employing your own people and you're bringing manufacturing back into your country, those are all positives. I don't buy the nonsense that a lot of economists are saying. The bigger challenge for the U.S. though is it does have to balance its budget. I mean, it's running a $2 trillion deficit on revenue that's between $5 and $6 trillion. It's got unfunded liabilities, as you know, that is 100 trillion or more, depending on who you're looking at, a debt that's 37, 38 trillion, and so on. So these are imbalances that they are going to have to get back into, some kind of balance. And from our perspective, that will require a lower currency and some type of inflation. So adjustment. That's why we own the precious metals. But if you look at the U.S. economy and you compare it to other economies in the world, I think it's going to be by far the strongest. And that's just simply because they got money coming in. They're doing everything right in terms of the economics, in terms of the country. You look around the world, you look at Europe, especially Western Europe, it's abysmal. You look up here in Canada, the policies that our government's pursuing are just unbelievably destructive of our country. So, so I'm much more positive on the U.S. as a Canadian looking down and looking at what's happening in America. Again, that doesn't mean there aren't challenges, of course, but overall, I think it's probably by far the best place to invest if you can find businesses trading at reasonable valuations. Well,
it's amazing when you go back just a year ago, and there was so much concern about the U.S. economy. It was going to fall into a recession, especially with trade wars, and it was going to create a lot of job losses, et cetera. But here we are like a year later, and there's no stopping this economy. So you touched on the Canadian economy, and seeing how you and I both reside here, why don't we talk about that? And before we talk about but I just want to touch on the TSX composite. It's up 20% on the year, and for the most part, it's doing okay. You talked about the strength of the precious metals companies. The financials are also doing well. Royal Bank's up 20% on the year. TD's up 40% on the year. The last time you and I spoke, you did express some concern about the Canadian financials. What are your thoughts now? Has anything changed?
Yeah, I mean, we don't have an awful lot in the Canadian financials. They've done exceptionally well, and that's fine. I'm glad they are doing well because they're a backbone to the Canadian economy, and they provide the finances and capital for the economy. We just find other areas that we would prefer to invest in. And I do think that, again, the housing market in Canada is very weak, and that could, again, cause further problems in terms of credit issues for some of our banks. But the TSX, in terms of our stock market, has done well because of materials also. I mean, as you pointed out, has done very well. But a lot of the businesses on the TSX they might be traded in Canada, but they're largely North American and even global businesses. So a lot of them are making money outside of Canada, and they're very successful at it. Or they're commodities, and the commodities, as you know, have done very well. And that's all US dollar denominated type businesses. That's, I think, the reason why the TSX is probably not indicative of the Main Street in Canada, what's going on in the Main Street. There's really a dichotomy between the two. On Main Street, we're going to continue to feel a lot of pain across the country because of policies, but the TSX and some of the Canadian and businesses which are global businesses or doing a lot of business in the United States or commodity oriented, those are doing quite well. Yeah.
This October, Wealthion's putting the spotlight on silver with expert interviews, deep analysis, and a special in-depth report from our partners at SCP Resource Finance. To receive this report and other exclusive benefits, you can sign up to become an accredited investor with Wealthion at wealthion.com/accredited or by finding the link in the description below. Speaking of silver, Wealthion will be on the ground in Toronto for the SCP Resource Finance Second Global Silver Conference happening on Thursday, October 23rd. Legendary investor Eric Sprott headlines the event alongside 15 silver mining companies presenting their top projects. It's a must-attend for anyone serious about investing in silver. Tickets both in person and virtual are now available. Find out more in the description below.
Valid points. And just to provide a little more context for our viewers, especially our American viewers, the Canadian economy, the GDP in 2024 was 1.6%. In Q1 of this year, it grew at 0.5%. Q2, it actually went negative at 0.4%. A lot of that has to do with the uncertainty associated with the trade war and also exports. But maybe you can just speak to the economy and where you think our government has gotten it wrong and why the Canadian economy is so weak.
Yeah, if you step back and you look at the overall economy, this is both provincially and federally. Overall, we're a country with too many regulations, too much red tape, and taxes are too high. And so you're going to be put a stranglehold on capital, increasing your cost of money right off the bat. Then if you look at the federal government, which has been a liberal government since 2015, they have passed six major pieces of legislation between 2015 and 2024 that really throttle the oil and gas sector as well as the resource sector in general. And so that throttling of the resource sector, especially oil and gas, which is at the heart of the Canadian economy in terms of growth and prosperity and creating wealth, has meant that, again, according to top estimates, we've missed out on about $670 billion that has not gone into projects in terms of investments. It's left the country. Well, it hasn't come into the country, and then other capital has left the country. And so what we're finding is we're just not getting the investments in our country. So you put a socialist regime, a social welfare system across our country, and then you're not creating the wealth to pay for it. And then you flood in immigrants at a rate that is unprecedented. I mean, you're talking about, on a base of 40 million people, over 1 million people a year. So just a large number. And there's no way you can possibly grow GDP at the rate necessary to sustain the wealth of the people in the country. And that's why, as you point out, those numbers, we're seeing very little growth in GDP. But when you adjust for per capita, per person, it's actually negative. I would also argue that if you actually adjusted for real inflation, and because you're using government inflation numbers that you're adjusting those GDP numbers with, if you took real inflation, which I think is twice as high, if not more, than the real numbers, I think we've seen severe negative GDP growth in this country on a per person basis now for 10 years. And that's why Canadians are really feeling it. And they're feeling the pressure. And we've seen an increase in, bread lines and people homelessness and all of the things that you're going to get in a country when you're not creating the wealth. And so it's really a top-down liberal government. I would put the fault at the Liberal government, NDP government. These are two parties in Canada which are left of center, in really throttling and choking off our most important resource and wealth creation, which is the development of the oil and gas sector and other resources in the country. Yeah.
I agree with you 100% on what you said about inflation. It is, I just can't get over how resilient it's been. But if the government says the inflation rate is 3%, I just double it and assume it's 6% at a minimum. And I would also say the only thing saving us right now is the price of oil. Oil's trading around $60 a barrel. If it were to, rip to $80 or $100, and we've seen that happen before in a relatively short period of time, then that's it. Then we're really in for a lot of trouble.
We're in a country also that it really is gripped. It's gripped by a green ideology and a radical environmentalism at the government level, the federal government level, the Liberals and NDP, similar to what Biden was promoting in the United States. So for the American listeners, and so that radical environmentalism has meant carbon taxes. So they put carbon taxes both industrial on businesses, they charge for the use of energy, and also they had them on retail. So we were paying heavy carbon taxes at the gas pumps, which put the price of gas up. Now that was taken off because the Liberal government wanted to get back in power at the last election. But the problem is we've got these taxes all through the system. So we pay, even with the oil prices down, we're still paying a lot, heavy price for our oil and gas when we go to the pumps. And that, of course, filters through the whole industrial base. And this makes us a huge disadvantage when it comes to manufacturing jobs. And again, that's why we're losing these manufacturing jobs. In the United States, to the opposite effect, Donald Trump and the federal government down there is trying to get the energy costs down, get regulation costs down, get taxation costs down, have 100% write-offs of capital investments in your businesses. That is exactly what you need to spur economic growth. So in Canada, we're doing the exact opposite of what we should be doing. Donald Trump's doing a playbook on how are you going to grow an economy, how are you going to develop the economy. He's following that playbook 100%. So the contrast is quite stark. And again, Europe, I think, Western Europe is also following sort of a similar globalist Canadian playbook. And we see the results. They're devastating. And if you are not going to develop your resources and you're going to follow a radical environmentalism, this is a massive, massive cost. And it's going to lead to more deindustrialization for some countries, whereas other countries are going to get all the manufacturing and get the industrialization back. And I think that's what you're going to see in the States over the next few years if they can sustain these policies.
So we talked about how the Canadian economy is weakening, and this is coming through to the unemployment numbers. We're seeing a constant uptick or growth in the unemployment rate. It's currently at 7.1% across the country. It's at 8% in the province of Ontario, the largest province in Canada, 15 million people. And in the city of Toronto, it's 9.9%. And then youth unemployment across the country is at 14.5%. So we got some real issues here, and it's only going to get worse. Where do you see the unemployment rate going? Later in 2026, do you see us going into double digits?
The unemployment, I cannot see how the unemployment rate cannot go higher and probably substantially higher. And that, if again, you don't have capital flowing into your country. In fact, worse, you've got capital now leaving the country and you've got jobs leaving the country. It's much more encouraging to go to the United States. That's where the capital is going to be treated well. That's where you're going to have lower taxes. You're going to make more money. And of course, Donald Trump is putting the pressure on businesses too. So you put all that together and there's no way that we're going to see substantial amount of capital invested in this country. And we're seeing this just recently, Stellantis, a significant auto manufacturing up here in Canada, is moving a lot of its facilities down south of the border again. And that is not a surprise. That is very predictable. If you're Stellantis, you're not going to keep a lot of your manufacturing up here in Canada with the pressure that Trump is putting on. And also the cost structure that we have in Canada is no longer competitive. It's much more competitive in the United States. So you put that together, put both those points together, that you're getting encouragement from the U.S., you're getting pressures with tariffs, and at the same time you have a lower cost structure in the United States and more favorable terms from a capital perspective. This leaves, and so that's 3,000 jobs in one snap here in Ontario. So Ontario is going to see a significant reduction in our auto industry, auto parts, auto manufacturing, auto assembly. Whether we like that or not, that's just the reality. And so that in and of itself will have massive spin-offs. As you know, that industry is very well paying. And then you take jobs out, and then you get all of the services around it, restaurants, all the other businesses that are involved in a city. Those businesses are going to suffer also. So I see the unemployment rate going up by a couple of points. Yeah, we could see some very high numbers over the next couple of years if we don't change policy.
And just to provide some more background on how important the auto industry is in Southern Ontario, it employs in the auto assembly industry 40,000 people directly. And then if you look at autos, trucks, and also supply chains, you're looking at 150,000 people. So it's a very important sector to this economy. And I can only imagine Stellantis is the first company to do this. And you did touch on this, but just to provide some further numbers, Stellantis said they're going to invest $13 billion over the next 4 years, and that's going to create 5,000 jobs in the U.S. So I agree with you totally. We're going to see a lot more pain here in Southern Ontario.
Yeah. And again, a lot of this is self-induced, though. I mean, if you go back 30, 40 years in Ontario, for example, I mean, we were an incredibly efficient place. Energy costs were low. Taxation was competitive. Our education standards were much higher. Our healthcare system was actually functioning. Now you look at all of those areas, and we've got problems in all of them. And so we are going to pay up for our lethargy, for our poor management, our incompetence at almost every level of government. And so we've gone from a real powerhouse to one that is seriously lacking. So we need changes. We need dramatic changes, and we need leadership in Canada, both provincially and also federally. And we're not getting that to the extent that we need. We've got some good leadership, I think, in Alberta, Saskatchewan, some good leadership out west, but we need to change the government in Ottawa as quickly as possible, and we need to put business people back in. We need a free market capitalist economy to take advantage of the massive resources we have that create the wealth that's necessary. See, what people don't appreciate is if you get into a redistribution and you focus on just how are we going to redistribute assets, and you don't focus on production, then you're going to have a lot less to redistribute, because people don't produce what is going to be taken from them, and they don't invest, and they don't stay in that country if they think their assets are going to be stolen from. And that's basically what we're seeing in Canada. And we're going to have a flight out of this country, both in terms of brain drain, some of our top talent, and our capital, our jobs. And this will have a lasting impact on our country if we don't make dramatic changes quickly.
And I think we should also state that at the federal level we have a liberal government, but at the provincial it's conservative. And but even Premier Ford, the Premier of Ontario, I got to say I think the guy's doing a horrendous job. Like, he's just grandstanding all the time. Everything he does is just for headlines. It's not helping the situation at all. I think his actions are only making it worse.
Yeah, what we have in Canada with Premier Doug Ford is that he's what would be called a sort of a rhino in the United States, Republican in name only. So he calls himself a conservative, but he's not a conservative. It's simple as that. It's policies. You judge a person by their fruit, right? You judge a tree by its fruit. You judge a person by its actions and policies. And his policies have been left of center, and they've not been positive for the business community in Ontario. And so what we need, again, is true leadership that will restore a free market and a free movement of capital and more efficient bureaucracy. Bureaucracy needs to shrink. We're seeing this in the United States. The first thing that Donald Trump has tried to do is shrink the bureaucracy. You've got to cut back the bureaucracy. It's too big. It strangles the private sector. And we've seen that again in Western Europe. We've seen it in, any country that adopts socialism, the public sector becomes too large, and it just basically swallows up the private sector, and you don't get the wealth creation that you need.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's hardassetsalliance.com.
So in the last few minutes, you and I have discussed the weakness within the Canadian economy and where we think it's going in the coming months and the coming years. And it sounds like we're in for some pain. But how do you and your team at Rocklinc suggest you build your portfolio in this environment. So maybe you're not making money, but at the same time, you want to protect your money.
Yeah, great question. And I mean, we're fortunate we're in a business where we can move the capital all around the world. And so we're parked just south of Toronto, and that's wonderful. And but we can take Canadian dollars, Canadian money, Canadian investors' dollars, and invest that all around the world. And so that's what we're doing. So we're not we have some great Canadian companies, but most of them are operating throughout North America or global businesses. What we're trying to do is find businesses that are in preferred sectors, sectors where there's underlying growth trends, secular growth opportunities. So as we've talked about before, looking in the technology space, one area in technology that's been weak the last year or two is software. Some of the software businesses have really underperformed, and so we're in that space, looking at businesses that continue to grow 8-9% a year, and yet the stocks have done nothing the last 2 years, and they're creating lots of free cash flow. We have one company called Roper Technologies, which is a great business, and we're shocked at its valuation and the fact that it's really gone nowhere in the last couple of years, despite growing in a consistent way. So looking for growth sectors. We have some in the healthcare space. That's another area that's been very weak. Danaher, Thermo Fisher, big manufacturers of equipment, medical equipment. People, again, have poo-hooed that whole healthcare sector. That's underperformed. We've got some that is exposed to the data centers. I mean, the data centers, we have about 12,000 in the world now, and they're telling us we're going to have about 90,000 by 2050. But whether we get to 90,000 or not, we're going to have a lot more than 12,000. And so, Schneider Electric, some of the Brookfield assets are building out the data centers. And so you can get exposure to that sector without necessarily owning NVIDIA. Other areas include the precious metals. As we've talked about before, one of the concerns we have is just the global buildup of debt, which is unsustainable, including the United States, which again is doing a lot of right things in terms of building its economy, but it's still overspending and it's heavily indebted. Canada, overspending. We're getting a budget next month. I hate to see that one. The UK is in an abysmal financial position. I mean, their debt to GDP has quadrupled over the last sort of 15, 16, 20, 16 years or so. It's just crazy what's going on in the UK. France is on the edge and on the brink too. So when you look around the world, we want to own precious metals, even though gold and silver have gone up quite a bit. We just cannot see any path forward where fiat currency does not continue to lose purchasing power over the next number of years. So we're heavily invested in that space, and we've been rewarded. And we're careful. We know it doesn't go in a straight line, and so we're looking for any kind of pullbacks. We might add some more, but to being disciplined in that area also. So those are some of the areas that we're, again, just picking off, adding investments and looking for really solid, well-run companies with smart people who can navigate challenging environment.
And Jonathan, when you say you're heavily invested in precious metals, can you quantify that?
Yeah, we have pretty close to probably about 28% of our assets in precious metals. And in some cases, because we're carrying some cash, if you look at our weighting as a percentage of our equities, so our active investment, I'm using the interest-bearing securities as a bit more inactive, short-term, just interest-bearing stocks. It could be much higher than 30%. So we're carrying unusually high weights in the precious metals vis-a-vis most of our competitors. And we've built these positions over the last 15 years. It's not like we've just added them the last 2 years or something like that. We've been very concerned about the debt crisis and some of the challenges with our money for some time, but we just continue to add and build larger positions over time. And so we own a lot of the royalty companies. And we've also gone downstream in the royalty companies. We bought some of the mid-tier and some of the smaller ones. Just before this call, I was on a call with the CFO of one of the mid-tier royalty companies that we're looking at now. So again, just trying to find value wherever we can and good solid growth in that space. And
what about silver? Do you own any silver producers?
We have Pan America, and Wheaton Precious Metals is probably about still 40% or so silver, we have a couple smaller, silver positions. Silver is also embedded in a number of the royalty companies as they do, their GEOs, their gold equivalents. So we have some exposure to silver. We have a little bit in an ETF. I don't generally buy ETFs. We buy individual stocks, but we do have one of the Sprott silver miner ETFs because, again, just gives us a smattering of silver companies, so we don't have to be precisely wrong if we get a wrong company. But yeah, silver is intriguing. As you know, there appears to be some substantial shortages, physical shortages, and that's one that we're watching and to see if there's more opportunities there. Because as we know, over the years, this is one reason why we've been in the space, but we've always gone for physical, or either buying the businesses or having the physical assets one for one. And that is that the paper markets are ridiculously large and have, I think, kept the price down of both gold and silver. And if people do require some of that bullion, I think it could really scare the paper markets, and the paper markets could be exposed as I think the fraud that they are in many cases. So we could see some substantial moves in silver and continued growth in the gold because of that, as people look for the true value of what these really should be trading at, not just the derivatives and that are flipped on the market.
Yes, and 75% of all silver is produced as a byproduct, so it's very tough to find pure silver producers, and that's why it's probably best to look at an ETF as you suggested. Well,
Yeah.
Jonathan, I have...
And one last point. I mean, again, you look at the growth in digitization, the data centers, all of this long-term trend and so forth. I mean, over the next 25 years, as best as possible, we're going to need about 100% increase in the production of silver by 2050 if some of these trends continue. Now, again, maybe they don't continue to the same extent, but the reality is we need a lot more silver, and it's not easy to come by. So, silver production has not been growing in any substantial way over the last number of years. And so, again, there's going to be some shortages in some of these very strategic commodities, including some of the precious metals. So, from our perspective, that provides opportunities. We just have to be able to understand what we pay for it and what are the best ways to get exposure to it.
Well, Jonathan, I always enjoy our discussions, and I want to thank you very much for spending time with us today. If any of our viewers, our Canadian viewers, would like to have a chat with you or another member of your team about how they can protect their portfolios in the coming years, who should they reach out to, or where can they find out more information?
Yes, we really appreciate that. We've had some wonderful people come through Wealthion, and we'll give a free checkup for anybody who approaches us and give you an idea of what your existing portfolio looks like and how we would fine tune that and alter it and personalize that for your own needs based upon your risk tolerances. So yeah, reach out to us. Probably our website's the best. Rocklinc.com, ROCKLINC, so link with C.com. And if you email us at info at rocklinc.com, we'll respond right away and have a great discussion with you. So by all means, reach out if you have any kind of questions, or if you want a second opinion on your existing, your current financial position. That's what we're here for. We'd love to work with the clients. And
we should also mention there's no obligation.
Yeah, absolutely. Yeah, no obligation, no fee. You come in and we'll, again, evaluate the situation and tell you what we would do, and no pressure. If you like it, then we'll take you on. If you don't, then you can continue doing what you're doing.
And it's always good to get a second opinion. Jonathan, once again, thank you.
Thank you very much, Jimmy. All the best.